Hey everyone, welcome back to Corporate Decoder, the place where we unwrap the messy, complex world of corporate finance and figure out what it actually means for you and me. Today we're diving into Twinlab Consolidated Holdings Incorporated latest quarterly report. And let me tell you, a lot is going on under the hood. This report is like a company doctor's visit, some good news, some bad, and a whole lot of things requiring close attention. A quick heads up, if you like getting these kinds of straightforward, no fluff insights into company filings, make sure you subscribe and hit that notification bell. Also, join our Discord community linked in the description below for discussions and sneak peeks. So, Twinlab Consolidated Holdings Incorporated is putting out their report for the period ending the 30th of September, 2024. This is a big one, giving us a snapshot of their financial health right in the middle of the year. Let's see what the numbers are telling us. Alright, let's peek at the big picture, starting with their balance sheet. This is like looking at all the stuff the company owns and all the money it owes at a specific moment. As of the 30th of September 2024, their total assets, or everything they own, were about $7.6 million. That is down from over $9 million at the end of the previous year. This drop signals they either sold off some assets or their value decreased. Now, for what they owe, their total liabilities are a hefty $153 million. That is a significant increase from $148 million at the end of 2023. It means they re-carrying more debt or owe more money to others. And here is a critical point, their total stockholders deficit is a negative $145.4 million. This means that if you add up all the company S debts and subtract the value of everything it owns, you end up with a big negative number. Basically, the company owes more than it is worth on paper. This is a big red flag that we see quite often with companies facing tough times. Now let's move on to how they performed financially. This statement shows their earnings or losses over a period. For the 3 months ending the 30th of September 2024, their net sales were $2.3 million. This is a pretty big drop from $3.7 million in the same period last year. That is a 37% decrease, meaning they sold a lot less. For the first 9 months of the year, sales are down 22%. This is good. It's like losing more than a third of your business in just 3 months. Their gross profit, which is what's left after paying for the cost of making their products, also took a hit. It fell 52% for the 3-month period and 32% for the 9-month period. This means not only are they selling less, but they're also making less profit on each sale. This is a double whammy. When you look at their operating loss, it's $746,000 for the 3 months compared to a loss of $202,000 last year. So they are losing more money just running the business. For the 9-month period, the operating loss is almost the same as last year. And the bottom line, their net loss from continuing operations was $2.7 million for the 3 months and $6.6 million for the 9 months of 2024. These are significant losses that are hurting the company. They do have some income from discontinued operations, which helped a little in the most recent quarter. But overall, it's a mixed bag. The main story here is lower sales and lower profits. This statement really highlights the negative equity we saw earlier. The accumulated deficit, which is the total of all past losses minus any profits, has ballooned to a staggering $376.5 million. This is a massive amount and shows how long this company has been losing money. And as we saw, the total stockholders deficit is a huge negative $145.4 million, reinforcing that in accounting terms, the company owes more than it's worth. Let's look at cash. This is the lifeblood of any business. How much cash are they generating or using? For the 9 months ended the 30th of September 2024, their net loss from continuing operations was $6.6 million. But here is something interesting. The net cash provided by operating activities was $634,000 for the 9 months. This means that even though they reported a big net loss, they actually generated a small amount of cash from their day-to-day business operations. This can happen because of things like changes in inventory or how quickly customers pay. On the financing side, they used $639,000 for the 9 months. This typically means they either borrowed less or paid back debt. And their cash at the end of the period, a mere $14,000. That's almost nothing. This lack of cash is a huge concern and ties directly into their going concern warning. The company's main business is selling vitamins, minerals, supplements, and sports nutrition products. They also used to have a service for private label distributors. But here is a crucial detail from the notes. They mentioned that the services performed under NutriScience Labs, or NSL, ceased with the abandonment of operations that began in July 2023. This means a whole part of their business is gone. And then we hit the going concern section. This is where management has to be upfront about whether they think the company can survive. They state there is substantial doubt about our ability to continue as a going concern. This is a very serious statement. They explain that they have a history of losses, significant debt, and a working capital deficiency, meaning they owe more in the short term than they have in cash readily available. They need to raise more money through debt, selling assets, or other means just to keep going. If they can't get this funding, bankruptcy is a real possibility. This is the most critical takeaway from this report. Here they discuss accounting policies. They mention discovering errors in how they accounted for discontinued operations, specifically a lack of segregation on their balance sheet for discontinued assets and liabilities. While they say it wasn't material enough to restate past financials, it shows there might have been some accounting messiness. They also have contract liabilities, which are basically customer deposits and guaranteed returns. These are recorded as accrued expenses and other current liabilities. The numbers are in the millions, showing the scale of their customer commitments. When we look at accounts receivable, they have allowances for customer claims and credit losses. They are estimating potential losses on money owed to them. The total allowances as of the 30th of September 2024 were $318,000, with a portion for doubtful accounts and another for expected credit losses. The earnings per S-hair or EPs is a tiny fraction of a cent, and it's negative as expected given their losses. Basic EPs is negative $0.01, and diluted EPs is also negative $0.01 for the 3-month period. For the 9-month period, it is negative $0.02. This just confirms the company is currently losing money for every share of stock out there. This is a big one for risk. The company relies heavily on a few big customers. The top 3 customers made up about 50% of their sales in the last quarter and a huge 54% in the first 9 months of 2024. One single customer accounts for around 26% of their sales. This concentration is risky. If even one of these major customers walks away, it could cripple Twinlab. This is a classic sign of a company in a vulnerable position. Their inventories have decreased significantly, from $3.4 million at the end of 2023 to $2.7 million by September 2024. This could be a good thing if they are streamlining, or a bad thing if they are selling off stock because demand is low. Their property and equipment is almost non-existent, just $1,000 net. This suggests they do not own much in the way of buildings or major machinery. This section talks about intangible assets like trademarks. They have $120,000 in intangible assets, net of amortization. Notably, they recorded an impairment loss in 2022 on customer relationships related to NSL. This means that portion of their business is no longer considered valuable. This is where things get really dense and important. Their debt situation is complex and involves a lot of related parties. They have over $90 million in total debt. A huge chunk of this is related party debt, meaning it is owed to people or entities connected to the company, S leadership, or major shareholders. The total related party debt stood at $90.9 million. This includes notes payable to entities like Little Harbour, Great Harbour Capital, and Golisano Holdings LLC. The interest rates vary, but many carry a significant burden. They also have a senior credit facility with MidCap, which was $2 million as of the 30th of September 2024. However, they were in default on this covenant. This means they failed to meet a requirement of the loan terms, which can lead to serious consequences. The notes detail extensive arrangements with entities like Little Harbour LLC, Great Harbour Capital, LLC, and Golisano Holdings LLC. Many of these loans have past maturity dates, and the company is in default. They are trying to negotiate extensions, but there is no guarantee. This is a really precarious situation. It seems like they depend heavily on these related parties for funding, and if those relationships sour or terms aren't met, it's a huge risk. The fact that these notes are in default and the company is trying to extend them is a flashing red light for their financial stability. They also had a term loan with Makatawa Bank, which was settled in November 2024 by surrendering collateral. The remaining interest in this debt was then assigned to Accretive LLC. This shows a complex web of financial arrangements and assignments. This part deals with warrants, which are like options to buy stock. They have outstanding warrants representing a potential dilution of existing shares. Some warrants have expired and others are still active. The November 2018 GH warrant, for example, expires in November 2024. These warrants, especially the escrow ones, were often tied to loans and would only become exercisable if the company defaulted. The expiration of many of these warrants without exercise is noted. They have operating leases for office space. Some leases have been surrendered or are causing losses due to sublease issues. For instance, they incurred significant impairment losses related to office space in St. Petersburg, Florida, because they can't find a subtenant. This shows how even everyday operational decisions can add to financial strain. This is where they officially discuss the wind down of Nutrascience Labs, or NSL. They ceased operations and abandoned related assets. The net income or loss from discontinued operations shows a small income of $28,000 for the latest quarter, contrasting with a loss of over $3 million in the same period last year. This move out of NSL is a significant strategic shift, indicating they are shedding parts of the business that are no longer viable or strategic. This section reiterates the lack of preferred stock issued and details common stock information. It also mentions the Twinlab Consolidation Corporation 2013 Stock Incentive Plan, from which all awards have vested or expired, and a stock subscription receivable. That is a tiny balance of $30,000. Here they talk about new accounting rules they need to adopt. The new rules about segment reporting are coming, and they are still assessing the impact. This just shows that accounting standards are always evolving. This is where management explains all the financial numbers. They talk about their integrated marketing business and brands like Twinlab, Reservage, and Metabolife. They also explain the discontinuation of NSL. Again, they stress the going concern uncertainty, highlighting their history of losses, working capital deficiency, and the need for additional capital. They mentioned focusing on core brands, cutting costs, and negotiating with suppliers. This is a business fighting for survival. The discussion here repeats the financial results we saw earlier, emphasizing the decrease in net sales and gross profit due to supply chain issues and reduced demand from major retailers. The drop in net sales of 37% for the quarter and 22% for the 9 months is directly linked to these supply chain problems hitting their most profitable products. The decrease in gross profit echoes this, directly impacted by those same supply chain issues and lower demand for their high margin items. Selling expenses are down, which makes sense if they are cutting back on marketing and advertising because of financial constraints, a 63% drop in both periods. General and administrative expenses are up slightly for the quarter, largely due to lease impairments, but down for the 9-month period mainly due to reductions in salaries and wages. Interest expense has decreased slightly, mostly due to lower borrowing costs, but with over $90 million in debt, this is still a significant cost. They have very little cash on hand, about $14,000. This limited liquidity combined with their debt obligations paints a grim picture. They admit they will need additional funding from their revolving credit facility to get through the next 12 months. While they had a net loss, they managed to generate a small positive cash flow from operations for the 9 months. However, financing activities show a net repayment of debt, and their overall cash position is extremely low. They explicitly state they will need additional funding, and that they cannot predict if it will be available. They also detail the past deferment letters from lenders, and the fact that these notes are now in default. This is a company in a dire need of cash and favourable refinancing. This section explicitly confirms defaults. They were in default on the EBITDA covenant for their mid-cap debt and also on the promissory notes to Little Harbour, Great Harbour Capital, and Golisano Holdings LLC, which are long past their October 2021 maturity dates. That's a lot of defaults, showing a serious inability to meet their financial obligations. Here is a candid admission. Their disclosure controls and procedures are not effective. They cite a lack of appropriate staffing in accounting and it as the main reason, which is hindering their ability to close books accurately and timely. They are working on it, but it's a material weakness that's not yet resolved. This is a critical governance issue, so what's the story with Twinlab Consolidated Holdings Incorporated? The company is clearly in a survival phase. They're facing significant financial headwinds, plummeting sales, shrinking gross profit, substantial operating losses, and a mountain of debt, much of which is in default with past due dates. The going concern warning is the most prominent takeaway here, indicating serious doubts about their ability to continue operating. Their strategy seems to be focusing on their core brands, cutting costs, and desperately trying to secure funding and renegotiate with lenders. The discontinuation of NSL is a clear signal of shedding underperforming or non-strategic assets. The heavy reliance on a few large customers and the critical lack of cash paint a picture of a vulnerable business. The internal control weaknesses stemming from staffing shortages add another layer of concern about their operational integrity. There are significant risks associated with their debt structure, the defaults, and the need for immediate capital injection. The company's future hinges on their ability to secure financing on favorable terms and turn around their declining sales and profitability. Without a substantial and swift improvement in their financial situation and operational execution, continuing as a going concern will be a significant challenge. Alright, that is our breakdown of Twinlab Consolidated Holdings, Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.